Welcome back to the Capital Mindset Show, guys. We're your hosts, Austin and Fabio, and this week we're looking at 7 stocks, a preliminary analysis of 7 stocks, by which we will do the due diligence set of videos next week. And our first stock is Corsair Gaming. So, Fabio, I'm going to jump right into this. Let's do this.
Yes. So just like a quick business overview, Corsair Gaming, for those who don't know, they sell a variety of hardware products. It includes, keyboards. So I know they are also big into the streaming space in terms of hardware with Elgato. Their main competitors that you need to be aware of are Razer, and I actually own some Razer products, and Logitech. In different peripherals, they compete. I know Corsair bought Origin PC, which I think, just clear that out there, is more or less a terrible business. The PC gaming business, when you build PCs, can be very unprofitable. But I do see the value in the Origin brand. So among the PC building brands, Origin does stand out. And Corsair itself does build their own PCs. But that's kind of just a quick breakdown. We're going to do, again, another video with a deeper dive with greater detail. So we're going to go ahead and pull up the model for
something
Corsair
interesting
Gaming.
I would also like to kind of mention about Corsair as well is that I own a couple of Corsair products myself. I built my PC back here with a couple of Corsair products. So I like the company itself, Fabio, but the only way after a due diligence into this stock, of course, but the only way during a preliminary analysis that we could really kind of see what we're looking at here is if we kind of explore these financial ratios that this model in essence offers. And then also too, if we kind of price it into our discounted cash flow. For those of you who might not know, this is what's known as a discounted cash flow model. And also too, if we kind of price it into our discounted cash flow model, and then we create a list of assumptions that we think Corsair might be able to achieve before doing due diligence, which we will do. So
here I just plugged in some growth rates between 10 to 30%. And what we can kind of see here is pretty obviously with the required rate of return around 15%, we would be looking to actually adding this position if we believe they can grow between 15 and 20% per year. Mm-hmm. And there is, however, I'm not assuming any buybacks or dilution at the moment. So Austin, what do you think about this one right here?
I would like to actually go into the numbers further just to kind of take a look at that, how that's calculating, Fabio.
Yeah, so
common shares outstanding.
Yep, total common shares outstanding. So they weren't even public back then. So that's some weird accounting thing. So I'm going to take into account that they've actually been diluting shares a little bit from from when they went public. And I know they went public in 2020. So we kind of have to ignore this. This is just like what they reported. We're going to go off of their public history. And we see a small amount of dilution. So I'm going to go back here. And let's say we assume a share dilution of around 1%. Okay, so even at 1% dilution, this is how the numbers kind of change. So I'm going to now eliminate the 10% and get somewhere between 15 and 20%. Let's do 17%. So 17% is about where we would have to make that assumption in order to justify an investment at a required rate of return of 15%. But just by being in the hardware business, let's look at some key ratios. And actually, real quick, let's look at an Altman Z-score. So ignore this calculator here, just focus on this stuff over here. And we see an Altman Z-score of about 4.65, which should tell us that the balance sheet is pretty healthy. P ratio of 15, price to free cash flow of 17. It appears to be cheap. And if we take a look at the growth rates, I believe they've been growing at around 15 to 20%.
Fabio, may I see the statement of cash flows, please?
Yes, you can.
Very curious about something. Can you scroll down to the cash flows from operating activities?
Let me actually make it smaller so our audience can see.
Okay.
You know, cash from
So then
operations.
cash from operations. Okay. So, okay, long-term debt repaid, total debt repaid, issuance of common stock. Okay, perfect. So
Dying in the
they
trenches.
are,
Dying in the trenches.
I
Stuff.
know, but I'm just taking a look at their statement of cash flows. I like to see that. That's kind of where I like to go sometimes when I first look at an investment, to be honest, Fabio, because what is the value of what an investment can provide a shareholder, right?
Yeah,
That you
well,
always say.
they have a free cash flow, so owner's earnings, and that the multiple you can apply on that right now is about 17.62. So right here
Yeah.
for these numbers, you can kind of tell that there is a downside surprise.
Mhm.
Because how do I know that, Austin? Because the ratio is greater on a free cash flow basis, so it looks more expensive, but it looks cheaper on a GAAP earnings basis. So that's actually not it's not a good sign, but it's not a terrible sign because it's not super different. So we can
Yeah.
tell the numbers by just looking at that. And
Mhm.
then if we look at the key ratios, let's actually highlight one by one. So let's minimize these. And we can kind of see the current ratio is pretty solid, healthy, and we see improvements. And then we see a long-term debt ratio. You see anything that sticks out in here? And then we should move on to the next ones.
Um,
I would highlight this one, the improved gross margins. That's a good sign. They are improving operating margins. Great sign. Net profit margins. Good sign. Return on assets. Great sign. Return on equity. Good sign. Everything looks like it's improving.
can we move to the inventory ratios too? Because
Those
I
are
would say for
probably the most
Corsair,
important ones.
inventory ratios would be incredibly important for
Well,
this
not the
business.
most important, but they're fairly important.
Yeah. Right.
So anything that sticks out here, I think it's pretty moderate. It's nothing
Yeah.
crazy.
I
So
would probably say so as well. Yeah.
we
It
saw in
seems
2020, you see what this, so it's for our audience, when this dip happened here, that's because everyone went crazy during that time in 2020 and started buying a ton of products. So their days sale of inventory was a lot lower. And then we're seeing it bump right back up. So we're seeing normalization. So that's what that number's telling me right there.
so, Fabio, to kind of segue from this a little bit, you referenced earlier when I was looking at the statement of cash flows, you said that I was in essence dying in the trenches. Would you kind of explain that for our audience a little bit, as well as why that could be potentially a bad thing as well, Fabio?
So this is a funny conversation Austin and I have a lot. And I have the experience of both finance and accounting. And so I got to see both worlds, and Austin's a very good accountant. He's a very good auditor, and he has the brain for auditing. And something that the finance community can say about accountants, well, accountants and finance guys, they have their rivalries. And I noticed from both because I'm part of both worlds.
Yes.
And the finance guys will say to the accountants that they die in the numbers, they die in the trenches. So the balance sheet or the financial statements are like the trenches that they die in. So they always like to find and nitpick things. And then in finance, you kind of learn quickly how to like derive a story from those numbers, because the accountants make the financial statements and the finance analysts read the financial statements and derive a story from it. So that's something when I say is like he's dying in the trenches. It is something that all accountants are.
Yeah, it's like this level of like friendly rivalry almost that Fabio and I even kind of have with each other sometimes when it comes to these certain things, because that does happen to me. But then again, that's also my personal investing style. I just like to go through the financial statements and nitpick things. So being completely honest,
before we leave Corsair, initial thoughts. Looks interesting or doesn't look interesting?
It looks very interesting to me, Fabio. I noticed that they kind of had a low cash ratio earlier, although it was improving. I noticed that it was low. However, I would like to do personally more due diligence, to which we will do. And then from there, I would kind of like to look more at their acquisitions and kind of see how that relates to their business strategy overall, as well as to see the way that they are managing their inventory, because inventory is so crucial to this business.
I agree.
So in essence, those are the two things that we'll be posting a video about this later this week, but those are the two things coming into our due diligence that I would really want to look at, Fabio. So,
all right, I agree. Okay, so for me, quick verdict is yes, it looks interesting. on a surface level analysis. Then when I look deeper, I might find things I don't like. I might find things that I like more. But for now, I see that the numbers kind of make sense, and I will have to discover what discount rate I actually want to apply. We're just applying kind of a standard above market average required rate of return, because why would we want otherwise?
Yeah.
So
thank you for watching our preliminary analysis on Corsair Gaming. Please be sure to tune in tomorrow. We're your hosts, Austin and Fabio. And if you've liked what you've seen here today, please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. And we hope that you have a great day.